The impact of the coronavirus on the US economy is far-reaching, and governments have started stepping up, for better or worse. Because here's an important question that keeps coming up. Is the aftermath of the government cures going to be worse than the coronavirus itself? For the short answer, probably not. Flattening the curve might save over 500,000 lives in the US alone. Forced quarantines, shutdowns, and social distancing are slowing the spread. This gives more time to develop treatments and build life support systems like ventilators. It also prevents hospitals from becoming overwhelmed. And this chart shows what I mean. The dashed line going across shows healthcare capacity, and the two arched lines show two different outcomes, one with protective measures in place, and then the other without protective measures. And ideally, we want to delay a lot of the infection so we'll be able to provide the support that's needed for everyone that comes down with the virus over time. Also, I'd like to give a quick thank you to nurses, doctors, garbage collectors, grocery store workers, delivery workers, and many other people on the front lines. You guys are the ones that are vital to saving lives and maintaining our way of life. Yet you're often overlooked, so thank you for your work. On the surface, flattening the curve seems like a great decision, although a forced economic shutdown is sending the US into a recession. It's self-induced pain that also has deadly consequences. For example, the number of suicides and opioid deaths climb with unemployment. Depending on the severity of this recession, those factors alone could easily lead to an additional 30,000 deaths in the US. And there are also many other unintended consequences. So to shed some light on this dire situation, I'm going to cover 3 big ways the coronavirus is impacting the US economy. But first, I'd really appreciate it if you just tap the like button down below as well as subscribe to my channel. Alright, up first is record unemployment shocks the US economy. During the last US recession, the worst week for unemployment claims reached 665,000. And looking back over 50 years and the last 7 recessions, the max weekly claims comes in just a little bit higher. It reached 695,000 in 1982. And in this chart, you can see those past highs are vastly outpaced by the last 2 weekly claims. Each of them come in closer to 7 million. The coronavirus is impacting the economy in an unprecedented way. You've maybe seen this chart before, but the next one I have for you isn't as common. It shows continued claims, and this data is reported a week behind initial claims, but still, it's already hit an all-time high, about 7.5 million. But it will climb even higher with the next report. It will easily top 10 million continued claims soon. Every recession has seen a continuous climb in total unemployment claims. For example, continued claims were below 2.8 million at the end of 2007. Then by mid-2009, they had climbed to 6.6 million. So with history as a guide, the unemployment situation will likely get much, much worse. And quick side note, unemployment is one of 3 powerful trends leading to a new economic paradigm. I've put together, it's some of my favorite research on 3 trends, unemployment being one of them, and they point to one outcome. That's universal basic income. I'll drop a link to that research down below. Millions of Americans are already struggling to make ends meet. The loss of millions of paychecks is starting to send shockwaves throughout the US economy. And to help put things in perspective, consumer spending makes up about 70% of GDP, or that's total economic output. As people lose their income, they stop supporting businesses. Then as some businesses go bankrupt, more will follow. It's a domino effect. Many areas of the economy are feeling the pain. Restaurants, airlines, the auto industry, just to name a few. I could go into great detail about how the coronavirus is impacting each industry, although I'm only going to cover one of the biggest today. The coronavirus and shutdowns are leading to housing crisis 2.0. Housing makes up about 15% of GDP, and the last recession is still vivid in many minds. Yet housing prices have climbed well above pre-crisis highs. You can see this in this chart, And it's one of 6 trends that I covered in an article last year predicting a stock market crash in 2020. Now, this chart doesn't show home prices after adjusting for inflation, but even then, prices are above pre-crisis highs. Now, this buildup isn't as toxic as the past housing crisis. Lending standards are a little safer, along with the collateralized debt market, although record unemployment claims are going to lead to higher mortgage default rates. If unemployment climbs into the teens, the coronavirus housing crisis might end up being worse than the last collapse. But to counter the potential of millions of missed payments, the government has already stepped in. Borrowers with loans from Freddie Mae, Freddie Mac, and Ginnie Mae can now postpone a year's worth of monthly payments. And this is just one of many actions the government is taking, which leads into my third point. Uncle Sam puts on more weight, or big government gets bigger. As mentioned, the government has stepped up to save lives by flattening the curve. Federal, state, and local governments have forced businesses and communities to shut down. They have good intentions, but there's another dangerous outcome. The forced economic shutdown is leading to even more government action. Early bailout measures have far outpaced past intervention. The 2008 bank bailout came in at $700 billion. And since there have been some other ongoing indirect bailouts, which put that number higher, but that's a conversation for another time. Now, to compare that $700 billion, the recent CARES Act tops $2 trillion. It's the largest bailout in U.S. history, and there will likely be more handouts or bailouts here soon. The government is in uncharted territory, and debt is at an all-time high. Total public U.S. federal debt is above $23 trillion. It's a dire situation, and to help put it in perspective, I use an analogy with Putin and Trump standing in a pool together. You can check out that analogy and research with a link I'll drop down below. It's talking about the global debt and interest rate problems. Big bailouts also set a dangerous precedent. The government has started labeling companies that are too big to fail, but letting them fail would likely be better for our economy in the long run. Bailouts can prolong inefficient businesses and lead to excessive risk-taking down the road. Now, I'm not sure these trade-offs will be worth it. Sure, we're saving many lives, many older and immunocompromised lives in the short term, but it might lead to a worse long-term outcome, an outcome that also costs many lives. Now, of course, I don't have a clear answer of what path is better. The government and coronavirus are impacting the U.S. economy in many ways, although I hope my research today helps people think more about the big picture. What are some of the trade-offs over the long run? I appreciate it that you made it this far, and I'd really like it if you just tap that like button down below, as well as subscribe to my channel. And if you have any comments, please share. I read every note left below. So thanks for stopping by.